Welcome to Real Talk Real Estate, the show where we cover how to build wealth in real estate with no fluff, no BS, and no sales pitches. I'm David Greene, and I've been doing this for over 10 years. I've seen the ups, the downs, and everything in between. This is the show where we pull back the curtain and show it to you too. So if you want to build wealth through real estate or you just love learning about it, you found your home. Landry Fields, welcome to the David Greene Show, Real Talk Real Estate. Glad you're here today, man.
Hey, appreciate you having me on. Excited for our conversation today, and it's going to be an important one, I think.
Oh, absolutely. This is the thing that everybody's talking about behind the curtain of real estate investing, and nobody is talking about out in the open on social media, on YouTube. So I'm excited to pull back that curtain and share with the audience what's going on in the world of insurance. So let's start off by just letting you give a little brief description of yourself, what you do, how you got here, and what role you play in this whole game.
Yeah, so I own an independent insurance agency. So I'm obviously in the weeds on that side of things every day, and I've owned my own practice for not practice, but agency itself for 6+ years now. Regionally, anything from Georgia north to east of the Mississippi, usually, because a lot of times within insurance, it's not always a one shoe fits all scenario, but based upon where you are in the country, there's a lot of regional carriers that can be very competitive. So that's why we kind of stick to that niche, but. Born and bred in the state of Kentucky, where, yes, I love bourbon, as we all do here. No, it is not easier to find the good bourbon here because everyone here knows what they're hunting for. So don't come here expecting to find something you can't find in your own state. All right. But then live around all the beautiful horse tracks and everything like that here.
So that's how it is with bourbon. Can we find deals in Kentucky? Is there a ton of investors scouring over the deals too?
Oh, yeah. I mean, there's probably a 10-for-1 people hunting for bourbon. Compared to any other state. Fun fact about Kentucky, there probably is approximately now 2 full barrels of bourbon aging somewhere in a warehouse here for every one person that lives in the state.
Wow. So in the zombie apocalypse, this is where we all need to go if we want to get drunk.
Now, you can sometimes find good stuff at the distilleries themselves if you book some of those distillery-only type of products.
Okay. So you have a knowledge of fine wine, bourbons, and insurance as well, right?
Yeah. So then about 3 years ago, probably 4 years ago, really kind of went down the investing side of things as far as real estate and got into that side as well. So a little bit of a unique story there where I'm both on the insurance side, but obviously not heavily in the real estate investing, but I've got about 19 doors now with the business partner on that. And honestly, a large credit to just listening to you for many years in that sense, as far as finally having so many clients in that world. I was like, I've got to get into real estate. If anything, not necessarily, as you know, from I'm going to just make this my career and sit back and cruise at some point, but more or less from a tax perspective, a future retirement perspective, I really don't care if I'm making money from a cash flow perspective, as long as the cash flow is not netting me losses and covering all expenses type of scenario. So got into it about 2 years ago, a little over 2 years ago, and went from about 0 to 19 doors in the first 18 months. And so I'm usually, like I said, kind of both feet in both worlds a lot of times. Majority of the time in insurance. I'm very grateful for a business partner who allows me to kind of find the deals, and then together, once we close it, he kind of takes it from there, manages it, and helps figure all that out. So, but yeah, that's a little bit about me.
All right. Well, do you want to share a little bit about your previous life, that you were a rock star, I believe? Weren't you auditioning to be the lead singer for Creed, and Scott Stapp narrowly edged you out?
Oh yeah, you know it. Which ironically, after they've gotten so much flack, like a lot of those bands are coming back. I'm like, I kind of want to go see them in concert now, because I was probably a kid, a little bit too young back when they were all in their prime and heyday. But no, I kind of want to go to one of those concerts. But no, thought I was going to be moving to Nashville, which is not too far from me here in Lexington, Kentucky, for a kind of a frontman of a rock band. But I'm grateful for an unanswered prayer that life on the road would kind of sucked at the end of the day. Now that I have 3 kids, a wife, and beautiful wife that I love, to just go home and relax every day, and then you just don't get that on the road. So yeah, I'm grateful for the time I had doing that, but I'm also grateful that I kind of switched careers from an exciting on-stage performer to just selling insurance. But I love getting in the weeds, the idea of building my business from scratch, and the nuances of technology and how everything's changing. I really kind of geek out on that side.
That is a wise perspective that you've got there. I noticed that we often notice whenever we hit a red light when we're late for work, But when you hit a green light or 7 of them in a row and you got there barely on time, you never even notice it. You just expected it. It's easy to point out all the things that went wrong in our life and we were so close and we could have had something else, but then we forget all of the things that lined up perfectly to get us to where we are. So I appreciate you sharing that perspective about a door closing can lead to another.
My favorite saying, God never says no. He says, not yet, or I have something better.
Yeah. I've thought about that
If
too.
I'm just
I've
trying
thought
to
about
take that perspective.
no good parent gives their 16-year-old the keys to a high performance Ferrari that's going to get him killed. Right? Like, but every 16-year-old
If you
wants
do,
it.
I'm not insuring you.
Yeah, there you go. We're going to get into that too. Right. But the point would be we often want things in life that if we got them would lead to our destruction. We are not capable of handling that level of wealth or that level of fame or financial freedom where we don't have to work anymore. We could just sit around and do nothing. A lot of people would get themselves into trouble if they actually had it. And they're pursuing something that from one perspective, divine intervention or God might be saying, no, you can't have it because you're not ready for it. Just like I'd love to be able to bench press 500 pounds, but if you put 500 pounds on that bar right now, before I built up to it, it would crush my rib cage. It'd be a terrible, terrible thing. And so I've had to remind myself of that a lot in life when our goals are not happening. Maybe instead of being upset that our goals aren't happening, we should just be glad for the things that we do have right now, because that is what we can handle. And if you really, really, really want more money, more wealth, more fame, more status, more free time, whatever, ask yourself what you need to do to be able to handle it and see if then God starts allowing that to happen and opening those doors for you. But we're not going to get too deep into the weeds on that philosophy. Maybe we'll cycle back to that at the end of the show. Tell us a little bit about your business right now. What do you do in insurance and how do you help people?
Yes, we have carved out a niche. We do a lot of different things, but mostly a lot of real estate investors. So it's obviously a topic, like you've said, that, is happening behind closed doors a lot. But as everyone knows, the NOI on most people's portfolios, especially this year, 2024, is just getting absolutely hammered from an insurance perspective with the rising rates. And there's definitely things to point to in that perspective. And if we want to jump into that, I can point to 3 things immediately right off the bat in that sense. But it's definitely something that's going to be here to stay, I think. Not necessarily how drastically it's increasing, but it's just going to have to become a bigger percentage, I think, of people's net operating income that they're doing and dealing with every day that we've not really seen in many years. I mean, the entire industry was kind of not on the edge of a knife, but in a lot of ways, these drastic changes are having to happen, and we're just salvage what we know and understand as the insurance industry as we know it. So it's there for those worst day scenarios that we all hope never happens.
So for clarity, are you doing just homeowners insurance, or are you doing other kinds of property? Are you doing life, vehicle, auto? Kind of give us a big understanding of the different insurance you operate in.
So, we do definitely do the home auto. Every carrier likes for you to sell their life product a little bit. We stick to just kind of term stuff. But and then a lot more on the commercial side of stuff. So portfolios of rental property, apartments, complexes, different scenarios. There's a lot of things I would like to talk about too, as far as the changes within that respect too, because there's just so much that people never ask or within insurance as far as a property owner that can really make premiums a whole lot higher, a whole lot more expensive, not just not related to regional stuff at all, but really just some of the things that are having to happen that kind of floated by, were cool for a long time. But as what we call this as a hard market in insurance. For everybody that's in insurance, they know that. But for those who are not in insurance, basically what that means is rates are skyrocketing. Underwriting is tightening up as far as what they will say yes to, what they will say no to. Obviously, more no's than usual, as well as inspections. For example, most this year we've seen 3 to 4x just on all of my portfolio of stuff and real clients that we deal with as far as inspections go, where people were sitting on the same policy for 2 or 3 years. It was fine. Yeah, it went up, but all of a sudden they got hammered with a inspection and that said, here's a list of 5, 10, 12 things that we want either fixed, addressed, or show that you've done something with what we've asked. Otherwise, we're going to cancel you type of scenario. And so that's been almost 3 to 4x times the amount of people that are having inspections done on their properties and real estate portfolios. So, but anything mostly in the single family to duplexes, quadplexes to apartments, and even the commercial flex properties or shopping strips or something like that. So a lot of it mostly do with commercial property.
So mostly you're a property insurer. You understand how underwriters look at what it's going to cost them to rebuild something that breaks, what the risk would be of this thing going down. I know that most insurance covers fire damage, are there other things that people aren't aware of that insurance covers, like earthquakes, other disasters, flooding? What do people need to understand about what is actually insured when they get a policy on a property?
I mean, the basics is going to be fire and storm. I mean, that's going to be your basic coverage that you get for
Mm,
most things. There could be, depending on regional areas of the country, where maybe hail is excluded. You know, we're kind of having to speak in general areas because it can look very different, obviously, from California to Florida to Kentucky to the Midwest, Texas areas or whatnot. But so depending on different areas, some things may be standard, everything's maybe kind of optional stuff. A lot more optional things are usually flood policies. Flood is generally almost always an extra policy of sorts. And as you may or may not know, if you're going to be buying something in a floodplain, they changed the flood maps for the first time in decades a couple of years back. So if you're in a floodplain, you're paying a lot more than you used to be. And I pretty much see 90+% of the deals that end up having to buy a flood policy fall through because of how expensive flood policies tend to be. But outside of that, a lot of times we're really educating on sewer drain backup. So a lot of single family homes, if there is a basement scenario or other things like that, we make sure they have the coverage on there for sewer drain backup, because that means that if the basement floods, which, outside of a roof scenario, if there is a basement in that regards it's finished, normally it needs to have an additional coverage added onto there in order to cover all the damage that is assessed by said flood from, say, a sewer drain backup. It gets clogged. And as we all know, in rental property, we never get clogged drains from people flushing things down toilets. That's never happens to any of us.
mhm.
But that obviously becomes a very big problem. And so we want to make sure that that damage from that type of thing is covered as well, because typically that's not covered on a standard policy as well. But then you can have, depending on where you're at, hurricanes could be excluded. You might have to kind of add that back, or the way roofs are covered, especially for commercial property, is vastly changing. But usually they're covered. But right now, how they're covered is kind of the biggest change that we're seeing across the industry. Maybe not necessarily in places that have had high wind stuff like Florida or
Mhm.
Texas or something like that, but most states that had kind of like just general replacement costs on their roofs, that whole thing is kind of changing and now going to become more nationally the way we kind of have to view it, the same way the coastal areas have been kind of experiencing it for a long time now.
Okay, so let's get into what we're actually referring to here. Insurance is effing expensive. It's getting crazy expensive. From the time that I started investing in real estate, the big things that you would typically calculate under your payment every month would be principal and interest, taxes, and insurance. And then secondarily, not part of your payment would be CapEx, maintenance, vacancy. That was like your main things that you had to account for. And insurance was the smallest of all of them. In fact, I'll admit it was so small when I first started investing. It was almost an afterthought. Like if your cash flow back then was so tight that the insurance was going to mess up the deal, you shouldn't be buying that house. You didn't really need to think about it. Once you got an idea, I mean, I'm literally talking about $30 a month to insure some of like the properties I bought that were 5 years old, type of a thing. Fast forward to today. I don't know what the hell is going on, but it's knucking futz out here. Like, I mean, I had a property in Florida I paid 1.1 million for. I needed short-term rental insurance, and it's in a historic district. It's a little bit older. A total of 5,000 square feet. $26,000 a year was the cheapest policy, the cheapest one that I could find. And that was assuming somebody could do that at all. And then it had just spread from there. So share with us a little bit about what is happening with premiums, how much they've gone up, and what is causing these crazy high prices.
For sure. I mean, I'll point to three main things, and we can kind of dive into different weeds outside of that. But I mean, the three main scenarios are, if you look at a lot of historical maps from weather related, so obviously me being more in central mid east type of scenario, we're seeing a lot more of the effects of what I would say tornado alley, not necessarily tornadoes, but the effects of tornado alleys with high winds, straight line winds, hailstorms, some things we typically don't see, especially straight line winds. We never see that in Kentucky. And then 2 years ago, we had a huge straight line windstorm that just wrecked most of the houses in the state. So weather is playing a huge part of this. That's the first step. And I think probably by and large, most people could probably think, oh yeah, I've just seen a lot more heavier storms, maybe hail, just different things that have affected where I live. And again, we're speaking in general terms, obviously, because every part of the country may be a little bit different. So if I'm speaking holistically in that sense, especially in the Midwest and Mideast and so forth, those storms that came through kept coming through at a rate that was almost, depending on different carriers' data, anywhere from 2.5 to 3x the normal rate. And when I say rate, what we're looking at is CAT claims, catastrophic claims. That doesn't mean everyone died. Catastrophic claims just means large impact as far as losses, claims, number of claims, and so forth. So large claims and losses scenarios. So those CAT claims, when they're normally looking at their 10-year averages, their 15-year averages, their 20-year averages to kind of get an idea of what rates need to be so they can weather those typical storms that they're expecting to hit here and there and so forth. Well, all of a sudden they started happening, like I said, between 2.5 to 3x the times the normal rate. And that pretty much for the last 2 straight years has been like on a nonstop scenario. It feels like it's kind of started to kind of calm down a bit with the weather related things. But by and large, number one part of it was weather kind of got out of control in a lot of ways that they were not typically looking at from an historical data standpoint.
Okay. And when we say weather, Landry, what we're actually saying is the amount of damage that is being done to properties that insurance companies have to pay for, right?
Correct.
Okay.
And then in regards to the weather, though, I mean, usually, let me preface the rest of these points by typically, if there's a large cat loss scenario, hundreds or thousands of people that are impacted, typically the effects of how that's going to change rates a lot of times can be a trailing 12 or 18 month scenario before you start seeing before the rate changes end up happening to accommodate for the large losses that happen in order to kind of fill up that insurance bucket that they're required to meet as far as being able to pay out for claims. Well, when the storms keep happening at an unprecedented rate, back to back to back to back to back, most of the carriers never really did recover from those things, or were able to adjust in time. Now, moving on to point number 2, was at the exact same time, a double-edged sword, we have what would be 30 to 50% inflation, depending on what we're talking about as far as the cost to fix all said claims, with obviously the national inflation that's been happening. So we have basically 2 storms meeting at the exact same time, causing this huge rift in what would be the insurance market as we know it, where now it is almost 50% more expensive to fix roofs. I mean, not, again, we're talking general between areas, but usually 30 to 50% to cost to fix all these said roofs, damage from storms, hail on the siding, you name it. And the storms are happening 2.5 to 3x as far as the cat loss type of scenarios. Both of those drive what's called the reinsurance cost, which is the third main point. Reinsurance is obviously where the insurance companies themselves have to have an insurance policy so that they're not taking on the full amount of risk if they were to have something that they couldn't meet as far as their bucket of money was to be exhausted. So that's an extra layer of protection, as you or I, as the insured, know that even if the insurance company fails, they have a policy or something financially backing them to make sure that they can pay out those claims. The reinsurance cost, unfortunately, is driven by the first 2 factors, and their first 2 factors having happened simultaneously, obviously caused the reinsurance cost that every carrier has to pay to skyrocket as well. And so really, I say 2 storms, it was really 3 storms that all happened at the exact same time. Third one's due to the first 2 and is much bigger because both the first 2 happened at the same time, that the insurance carriers are basically 12, 18, 24 months behind getting those rates where they need to be. And by that point, they're just having to have drastic rate increases in order to make sure they can stop the bleeding, so that they are not negative for what has now been a 2 or 3 year consistent historical point of just negative year after year after year right now. And so they've got to get that under control. Otherwise, eventually there's no more money to pay out.
All right, let me ask you about this reinsurance thing you're talking about. This is the insurance that insurance companies buy to cover them if their losses go higher than they thought they could absorb. What is the problem with the reinsurance companies, or why are they charging more to the insurance companies?
Because of the large loss scenarios, they've had to be tapped. Basically, those insurance policies themselves and the insurance carriers have taken out have had to be tapped as well. Okay. Because of those large loss scenarios.
So basically, I'm going to throw some names out here. If I get some of the details wrong, let's just try to focus on the main point. You've got Allstate Insurance and you've got Farmers Insurance, and both of those insurance companies are trying to operate at a profit. If too many disasters happen, there's too many storms, they have to pay out too much, they don't make a profit. But then they have to go get reinsurance to cover them if their losses are greater than the money that their company actually has to pay. That reinsurance company that has to charge Allstate is also getting hammered by their insurance that they gave to farmers and they gave to Geico and they gave to whoever else is out there. So at the same point that
Yeah.
these insurance companies are not making a profit, their expenses on their P&L go up because the reinsurance rates are going up because they're getting hammered by every insurance company that's all having an increase in claims. Is that a good summary?
Very cyclical. Yeah, but yeah, it's a cyclical cycle, unfortunately. But yes, that's a good
So
summary of it.
so pardon the pun, but when it rains, it storms. Everybody's getting hit at the same time here, and this is really bad. Okay, so I've heard people talk about climate change being behind this. I've heard people say it's just a coincidence, like every 100 years or so, weather patterns are going to adjust. Not that it really matters when it comes to the business of this, but do you have any opinions on what is causing the increase in storm?
Causing it, not necessarily. I mean, it could be a number of those factors. We're just guessing after in that sense. But the conversation I'm usually having with most investors right now is we kind of expected 2024 was going to be like the year that like, okay, this is not letting up. And like I said, there's that trailing effect of 12 to 24 months a lot of times when they're trying to get the accommodate with their actuaries what the rates need to be in order to account for those cat losses. That we knew 2024 was because of 2 straight years of large cat losses where they were just going to have to take drastic actions on those rate increases. That being said, with hope and what a lot of people in the industry are hoping and seeing, and I'll point to some one factor that gives us a little bit of hope for that, and which is I would say we're hopefully at the top of a bell curve. And that next year would hopefully be starting the descent of a bell curve, and maybe that's not a steep drop off type of scenario. I don't think we would think it's a steep drop off back to, like no one's going to expect rates to go for our interest rates go back down to 2 or 3%. Obviously, I would say the same thing with insurance itself. But we kind of are expecting and hoping that starting in 2025, we see what we call a softening of the market. So a lot of carriers, I mean, there was a number of carriers I had where they flat out basically, I didn't see a sales rep for 2 years here, and they're like shut down for business. Basically, we're like, we're not taking new business type of scenario. Mm-hmm. Others were like, we're taking it, but again, we're inspecting a ridiculous amount of these properties, like what we were normally accustomed to doing, and so forth. So right. What I would point to in that is that I've seen usually as the coastal areas trend, so do the national markets. And we have from different contacts and agency owners around the coastal areas, Carolinas, the Gulf, on the east side here at least, where we've started to see a little bit of that softening according to them. And usually if that starts happening, that means that hopefully the national side will kind of calm down as well. But I would not expect that until at least 2025. I would still expect increases in 2025, just hopefully not as big as they've been this year.
Okay. So when you mentioned a bell curve, you're saying prices and the amount of disasters has gone up. You think that they might start to go down like the opposite end of a bell curve, and we might see less natural disasters, less storms that are leading to some of these increased premiums.
Hopefully so, but not that we get all the way back down to where we were. Just like we don't think interest rates will ever get back down to, or in the short term will not get back down, 3%, I wouldn't expect.
Now, part of this problem is going to be the increase in claims that are made. Insurance companies have to pay out. But I'm sure another part of it is how much it costs to rebuild the damage that gets done from these storms. Do you want to share what you've seen going on with replacement costs, labor, materials? I mean, heck, the cost to get the materials from one location to another goes up when gas goes up, when wages go up. So what's going on with actual inflation affecting the replacement cost, which affects insurance premiums?
Sure. I mean, as obviously everyone can see, if you were in real estate before 2 years ago, I mean, it's been nice because the amount of property value has increased like crazy compared to the last 2 years. At the same time, the replacement cost has pretty much followed that same suit. So, I usually talk to clients and I'm saying, let's take your single family house that maybe that's your rental property. And I would always usually point to the fact that let's say it's, $400,000 to buy this single family house. Well, you and I know that if we were to buy or to build on the lot right next door, the same exact house, same exact specs, same exact plan, it's going to cost more than that to build it in today's rates inflation. So replacement cost usually is higher from what's it going to cost to replace said property than it would be to buy it typically. That being said, a lot of the changes that are starting to happen, if I can start moving into that area with regarding to replacement costs and especially related to roofs, is definitely changing. And, not for some parts of the country, because as you and I know, like, Texas or Florida or some of these coastal areas, they've always had this kind of idea where you've got more skin in the game, especially from roof scenarios, more than anything. So what I'm speaking to is actual cash value versus replacement cost. And replacement cost is usually where your roof is insured 100%. If something happens to it, you're getting the full thing replaced minus your deductible. Everyone knows that. Actual cash value is more of the idea that honestly, it's the one part of your house that has a bit of a lifespan to it. And usually that's quicker than we think. So a lot of times 25 years, probably on average, depending on where we are in the country, there's a lifespan on that roof. It's not going to last forever. Everybody knows that. It's just like tires on your car. Like eventually you have to replace the tires of your car. Up until this point, insurance has usually been the one to be able to step in and replace that, even if your roof was 20 years old, or at least in these parts of the country, that was still a normal thing. Whereas, like I said, with Texas, Gulf areas or other parts of the country where that wasn't normal, that is going to become the norm, I think, nationally. We've already started to see that between, typically a lot of my investors, let's just stick to the single family home. And a lot of people obviously start that route with single family rentals where you would have $1,000 deductible a lot of times, right? I mean, that was kind of norm for a long time, or at least in this area. Not so much anymore. I've had half my carriers now move to $25 deductibles when it comes to wind hail, which wind hail usually is going to be storm related damage to your house, roof, or whatnot. So in general, to help counteract these aspects of rates increasing, you're also getting the idea of not only having to pay more, but also now have more skin in the game as an investor, because you're now either going to have a prorated roof scenario that you're not used to. And I encourage everybody to go look at this, because if it's one thing I know is we don't really know what's in our insurance policy. We just want to be able to call somebody and them tell us what's going on. But truly find out, is my roof at an actual cash value scenario? Am I now underinsured because replacement costs has skyrocketed? So therefore, am I going to be potentially assessed penalties? If I could address that for a second, the idea that you've got a $400,000 house, maybe I've only got $100,000 on a mortgage or loan or commercial loan or something like that. So I'm only going to insure it for $100,000. Well, that's not how insurance works. You're required to insure a property for either actual cash value, replacement costs, or higher than that at least an 80% threshold of what it would cost to rebuild that house. So if we're talking about that $400,000 house again, it's probably going to be a $450,000 or $500,000 line item on coverage A for what it's going to cost to rebuild that house. You've got to meet at least 80% of that number to be insured correctly. If not, you can get in excess of 30, 40, 50%. There's a calculation that anybody can look up of what that coinsurance penalty would be, but you could get assessed huge penalties and be in it for 10, 20x the skin in the game that you thought you were going to be with that deductible. So there's rules to live by, and understanding how that works, I think, is part of in real estate investing 101 that most people skip in a lot of ways.
Okay, so you mentioned that the rising cost of homes themselves has led to a rising cost in what it costs to rebuild them. So now you have to get a higher insurance premium because the insurance company has to spend more to rebuild your house if it burns down. But the cost of a roof doesn't adjust just because the value of the home went up. So these particular components are sort of independent of the cost of a house. So my assumption would be that the cost of a roof is going up because the cost of the materials to build a roof and the cost of the labor to get someone to work on it is going up as well. Is this something that you've seen in Kentucky and in other states?
Oh, yeah. I was just talking to a roofer the other day, this week actually, and a typical average roof for them that they were doing in the Central Kentucky market was $13,000 for your typical two-sided roofs that we would have on a typical rental property. Well, that number is now close to 18,000, and most of that is like you're pointing to, it's going to cost more for manufacturing, it's going to cost more for shipping, it's going to cost more for labor. There's obviously everybody understands there's from an inflationary standpoint, it is costing more to do everything. And I don't think people realize how many hands or things are involved that all now cost more, that end up driving the overall bump and increase in total cost at the end of the day. But yeah, exactly to that point.
When I was in college, I remember the first course I took was economics, and I had a pretty good teacher, and we talked about supply and demand. And this has nothing to do with the interview. I'm just talking about myself now. But I got the highest grade in the class in my first ever college course. And I just remember being confused how anybody didn't get an A. Like, it seemed so obvious to me how economics worked. It's like the studying didn't even, why do you have to study it? Now looking back, I realize my brain just works that way, the same way that people that can do calculus don't understand how people can't do calculus. But understanding supply and demand, if you can grasp it, you can understand the price of everything. When there's more people that want to buy a house, so increased demand, and not enough houses to buy, low supply, the price has to go up because you are competing with all the other buyers. When you have not enough people that want to do manual labor, like putting a roof on a house. I mean, roofing is universally known as one of the least desirable jobs that there is. It's done in the summer. It's hot. You have to do it fast. Nobody wants to not have a roof on their house. It's loud. The neighbors complain about it. It needs to get done quickly. You're climbing up and down ladders all the time. It's dangerous. You can fall off of roofs. Not all roofs are the same. Some have a higher pitch. Some have a lower pitch. It was typically done by people that did not have a lot of other options. There's not anyone out there that's making a lot of money that said, hey, I'm going to quit my job in corporate finance and I want to go climb on roofs in the middle of August. So we had people that didn't have other options to do it. And that means that they got paid a lower wage, which meant roofs were less expensive. In today's world, as wild as this sounds, manual labor is in high demand and there is low supply. People do not want to do plumbing. They do not want to be electricians. They do not want to put roofs on houses. They don't want to install drywall. They don't want to do anything that would make them sweat or burn a calorie. People want to have easier jobs physically and higher status jobs. So I think the most popular job I see out there right now is I want to be an internet influencer. I want to sit in an office, have everyone look at me, be in front of a phone, validate getting to express my opinion, get all the significance that comes from a following. It makes my life easier in the dating market because everyone knows who I am. Everyone wants that job. Then you get people that want to work in computer coding or they want to work in tech. At the very bottom of this is manual labor. We also used to have a lot of people that would do this work that were probably in the country illegally. They didn't have other opportunities to get jobs. There's a lot more of them now too. So what we have is if you want to pay somebody money to go do manual labor, you have to pay them more, which means the maintenance in your properties, which was typically done by people that were not making a lot of money, is now being done by people that are making a pretty good wage. So as a side note, if you're trying to make money in today's economy, don't take the path everybody is taking and go where there's a lot of supply. Go the path that nobody's taking. Invest in the markets where you don't have a lot of competition and learn a trade that not a lot of people are learning. And I think that contributes a lot to why roofs are more expensive. And when you have to repair subfloors from a flood, it's more expensive, or you have to do framing. Is this something that you're seeing as well? I know because you are a real estate investor, that the cost of repairs, maintenance, building, construction, all of this has gone up because there's less people that want to do these jobs.
Oh yeah, for sure. I mean, you have to get on a waiting list now sometimes for some of the trades aspect. And, you know, you and I know, and a lot of people have seen that. I mean, it's almost more easier to make more money going into a trade like plumbing or electrician or something like that these days, getting your your master license in that, and you end up making six figures within a couple of years, much quicker than a lot of other jobs out there.
Mm-hmm.
So a lot of times, yeah, the problem that might need to be fixed is sometimes even costing us money because we're having to put up a tenant maybe, or do something for a tenant because they can't live in the property because we can't get to it quick enough because of this. They're just all booked up. I mean, if you want to go make a quick buck right now and you have skills in those said trades, I've had so many clients that decided to end up just starting their own contracting business on the side or just going full time into contracting because of the said need that is out there for that. So by all means, I totally agree.
So the labor is up and the cost of materials is up because inflation is up. So to buy the shingles, to buy the wood, to buy everything is going to cost more. And I mean, inflation isn't just up, it's like doubled in a lot of ways. Like that's expensive. So if the cost of a roof used to be $8,000, it's now $16,000. It would stand to reason that if everything else doubles in replacement costs, your premium would also double, right?
Right. So premium would double, but a lot of it's because of storms too, and the frequency of claims having to happen.
Yep, there you go. That was the point. We're getting hit from every angle. So it's more expensive to do it. It's maybe twice as expensive to do it. And it's happening more frequently. Premiums are going to just get skyrocketed. And we're not used to this because for a long time, manual labor was not affected much by inflation. And the cost of these materials was not affected that much because inflation was just kind of a steady 3-4%. every year in a lot of cases. So this is really bad. And it seems like it came out of nowhere. But if you were paying attention a couple years ago when people like me were talking about quantitative easing, how much money the government is pushing into its supply, which actually on an economics spectrum here again, if you increase the supply of money, you decrease its value, just like economics works. And that means you need more of that money to buy the same thing. So we see now why everything is so damn expensive when it comes to replacing it. We have another problem of the companies that are providing this insurance are starting to say, we don't want to play this game anymore. We can't make money. We're losing money. We don't want to do it at all. And as those companies come out, you are now removing supply from the people that are out there that can offer you a premium. There's less competition. So the people that are sticking around can probably charge what they want. What should people know about what's happening with insurance companies that are leaving states like California, where I live?
Yeah, I mean, there's a lot of this happening in Kentucky. You see it a lot in Florida, other places where because of that, carriers have pulled out of states entirely, or like I said, hit the giant pause button. That right now we're just not accepting anything for a period of time. I think a lot of the things that can be done from a insurance perspective, or to be maybe not always done, some things that you can do as far as the client that is getting insurance, as well as to know of what's happening in this said hard market of what is maybe wasn't going to be a challenge over the last several decades, but is now becoming more scrutinized and harder as far as things to insure. My biggest pointing to that part, one of my biggest things I have conversations with that's definitely happening more locally here in the Mideast is the idea of, especially apartments, buildings, when we have, or what we in the insurance say, habitational. So commercial property that is inhabited by somebody as a rental property, is the fact of having two means of egress. So this is very important in the sense that it used to be a lot of carriers would write an apartment, say, there's a lot of these 70s and 80s townhouse type of style apartments where you've got all these doors on the bottom floor, and then you've got one on the first floor, one that goes up, and the person's living on the second floor. Very common. Maybe they got a deck out the second floor. But ultimately, if there was a fire up there, they only have one stairwell to get down. And so the way you think of that, and most every insurance carrier now is starting to add this, or has added this aspect of, are there two means of egress from those top floors, second floor or third floor? But a lot of times you can see an innocent, like I said, townhouse type of looking style building where they've got just a second floor, and you're just like, oh, that should be fine, no problem for insurance. Well, that's become a huge sticking point for a lot of insurance companies. So, some of the State Farms, Farm Bureaus out there, stuff like that, would still take those. But even then, I've started to see them really tighten up, or if there was one claim, drop it type of scenario. And when they won't accept you, that there, like I said, there's fewer options for you to go. And when there's now fewer options for you to go because they pulled out, or like I said, they tightened those reins on what they will say yes to, that restricts what is out there. Therefore, usually we can still find you options, especially on the independent side where we have what's called the excess and surplus market, which is kind of a non-submitted market where we still have access to insure you, but it's always generally not as great coverage, and it's going to be more expensive type of scenarios. But the second means of egress is a huge thing that I've definitely seen change as far as becoming a very hard scenario that used to not be that hard at all. The way, again, back to the way I would think about it is, can your grandmother get down if there's a fire? It has to be two stairwells somehow. And you see that a lot in bigger apartment complexes, when that's usually not a problem. A lot of the times it's when we've got, like a quadplex or something like that we've gotten. A lot of it's times it's a smaller investor out there that really doesn't ever think about this, or has never been a problem up until this point. Another scenario I would say that really is hindering what allows you to even be able to get a policy sometimes right now is quantity of claims. I would say most people don't realize that the quantity of claims, whether that claim was $0 paid out, meaning you filed a claim, it wasn't accepted as a claim, saying it was something else that wasn't insurable as far as what happened, that has become a huge sticking point. And I think people just need to be aware of that too. And I have that with every investor client, is that I would rather let's get a roofer out there. Let's see what we can actually find before we just jump to filing a claim. I would argue never let a contractor or roofer file a claim on your behalf. Some states allow that type of scenario, but even then I would still be cautious, because even $0 claims get reported on either the National CLUP report, which is going to be for your single family, duplex, triplex, and quadplex, or on the commercial side of things in those reports. And the quantity of claims is probably the biggest red flag of all as far as from an insurance perspective, as far as willingness to write your business type of scenario. I don't think people realize. They just think, oh, I'm just going to file a claim, get an adjuster out here to see if it's covered. Well, you've already opened the door. There's no shutting that door as far as that goes.
Today's show is sponsored by Spartan League. Spartan League is my real estate university mastermind. Spartan League members get 5 calls a week on different real estate topics, including BRRRR, long-distance real estate investing, short-term rentals, medium-term rentals, long-term rentals, construction, floor plan changing, portfolio architecture, inspiring calls from other real estate investors that we bring in, like people on the Bigger Pockets podcast, to share how they built wealth through real estate, coaching calls, budgeting/defense calls, and more. You also get access to an exclusive online community of real estate investors and discounts on other events I offer, like retreats, accelerator courses, etc. If you want to know more about Spartan League, DM me the word Spartan or email mastermind@davidgreene24.com. Okay, so one issue is residential housing that does not have 2 forms of escape or egress is something that insurance companies do not want to have a policy for, and not every property was built with that. So people are being denied for these things more so than before. Now, my assumption here would be they've added this as an additional overlay or an additional thing to look at. They've tightened their standards because they want to insure less properties to reduce their amount of exposure to things going wrong. Is that a fair assumption?
That's a fair assumption. Like, for example,
Okay.
I've got a 12 unit I closed on last year. It did not have the same exact problem, but we immediately put stairs down off the deck on each upper floor property. That fixes that and made us a lot more viable option for a lot more carriers at that point.
But it's an extra expense on your property. You're still paying for it in some way. When these insurance companies tighten their standards, you're going to pay for it somewhere else to get that insurance. And that means that the insurance companies themselves are turning down business, which is how you know that, at least how I would think, they're not being dramatic here. They're not trying to rip off consumers. They are actually not making money if they're turning down business. If someone's coming to me and saying, David, I want a mortgage, and I'm finding more ways to tell them no, for whatever reason, I don't want to do more mortgages. So that would lead me to believe we've got a bigger issue going on. Now, something I did not understand about insurance until I dug into this deeper is that they can't just arbitrarily raise their premiums. There's actually a lot of regulation that oversees insurance companies. I had no idea about this. And so they prohibit them from raising their costs by a certain amount. Can you explain what that oversight looks like and how that works?
Yeah, in general, every state has a Department of Insurance, and that is to regulate different aspects of insurance. So that way the carriers have to answer first and foremost to the Department of Insurance in each state. That can change drastically as far as each state, as far as what those regulations are. Obviously, just like governance or laws in each state change drastically. But for the most part, they can't just file those changes without first being accepted by the Department of Insurance. Typically, for those states that have an easier time, Kentucky, they seem to have an okay time getting those rates changed when they need to. Other states, like I know, like California, had freezes on those things as far as I think there was, maybe you can answer this, where they had a period of time where it was like 12 months or more where they didn't allow changes at all. I can't remember the exact number, but in general, usually, yeah, they have to file those with the state of insurance, the Department of Insurance, in order to get those rates accepted by the state. That can change as far as what those exact rates are per carrier. Obviously, they're submitting that to the insurance department themselves. And then usually that takes effect on the first of said month. So usually we know if there's going to be an insurance change. Usually we've been made aware at least 2 or 3 months ahead of time that change is coming. So it's not like it's changing necessarily every month, but different carriers could change at different points in different months.
It also means that the government exercises some control over how much these insurance companies can offer, which means they have some culpability in this. And I'm not an insurance expert, but I am an expert in common sense, I like to think. And the government does not do a good job of looking at the big picture. They typically are very good at thinking about what will get them reelected. And that's about as far as their thinking goes. So every time I hear people complain about a politician, well, why are they doing that? They're thinking like a business person. Business people think with common sense. Politicians think about, well, what do the masses want and how do I give them that? Because I don't even know if it's their fault. They have to do that or they don't get reelected. Do you have a thought on that?
Yeah, I mean, and to expand upon that thought, and then the earlier at the beginning of this podcast with obviously your insane numbers that you were thrown at with Florida properties, that's just a prime example right there as far as how that can come into play with the departments of insurance in each state. So Florida, for example, everybody knows the insurance is crazy down there. Well, that's only really half. Everything we've talked about up to this point is, really only like the half the story type of scenario. A lot of it has to do with those legal aspects as far as their laws there with the State Department of Insurance. The main thing being what's called an assignment of benefits, or AOB. Now, there's assignment of benefits in a lot of different states, but unfortunately, Florida's was set up years and years ago in a way that had, again, they didn't think too far down the road as far as what the ramifications would be. What that basically means is that you would be able to, as the insured, sign over the rights to a claim to a contractor or roofer. What that led to was 70, depending on years right now, but 75 to 80% of all property insurance lawsuits in the United States of America were in the state of Florida. You can fact check me on that. It's an extremely high percentage, and that was because most of these contractors or roofers, a lot of them are going in there and basically taking advantage of that option, getting the client to sign over the rights to said claim. And now they were trying to nickel and dime, and therefore also suing said carriers for higher premiums, et cetera. So a lot of it's not necessarily the homeowners suing the lawsuits from homeowners. It's more or less contractors, roofers, and so forth, and lawsuits from them suing carriers in that sense. And then a lot of times, as I know and understand on the insurance side, you might not be at fault. You might, as an insurance carrier, you might be totally like, this was not even our client's fault, but it's much cheaper to not fight it in court. As we all know, it's a lot of times cheaper to settle it. And so that a lot of times they end up settling and paying out when they necessarily didn't have to pay out, or paid out a lot more than they were necessarily needed to. That's starting to change in Florida. They've started to change some of those stuff where you can now get the rights back as the property or homeowner from the insurance perspective, or making it a little bit harder so you can't just abuse that system. But that's kind of one of the big pictures with Florida, but a prime example of like we're talking about here, where State Department's insurance, just like taxes or anything else, they can play a role in that, and sometimes for good or sometimes for worse.
Well, if they control how much a company can raise its premiums by, and inflation is rising faster than a company is allowed to raise its premiums by, you find yourself in a position where to write a policy for Landry becomes something that I would lose money in. So now I have to find ways to reject new policies coming in because I'm mathematically guaranteed to lose money on them. But I may want to keep the policies I already have because I'm guessing those might be cheaper. They might be better for me. So I don't want to completely leave the area and shut down my existing book of business, but I don't want it to grow. Or I'm waiting to see what's going to happen with reinsurance costs before I decide. So it makes it a lot messier for these companies to make decisions. But in a lot of cases, they are leaving the areas.
Or they start, like I talked about earlier, analyzing and having inspections on the existing book to see which portions of it they want to get rid of. So you might be seeing non-renewals. You might not necessarily had a claim, but that's where you're like, hey, they're using a lot of satellite imagery now for roofs and so forth like that, for good and for worse. Like a lot of times it can be, like, okay, that roof that's just a shadow from the tree on top of the roof. That's not an actual tree leaning over the roof. The best thing you can do is, like I said, keep trees away from hanging over the roofs. And then just know that you could be non-renewed and it not be really anything you did at the end of the day. And sometimes you can fight it. Sometimes you have to just do what they say or go find another option out there.
All right. So what about people that are in states with insurance companies that are leaving? This is a big problem in California. I think I heard a stat that 7% of escrows in California right now are literally falling out of escrow because the homeowner could not get buyer's insurance, because the buyer could not get homeowner's insurance, or the insurance was so expensive, it screwed up their DTI. They couldn't get a loan. So what advice do you have for people that are in a situation like that, where they may be being told, we don't know anyone that can insure your property?
I mean, there's always usually something out there, whether you're going to pay for, are you going to pay for it? The independent side, that's where I like that flexibility. Independent, for those that don't know, I'm not beholden to just one carrier. So that's what we call in our industry captive. So, your Farmers, your Allstates, your Liberties, State Farms, and so forth, they're captive carriers usually. Liberties kind of changed a little bit. But in essence, if you call them, all they're going to be able to sell you is one product and from that company. On the independent side, I like the more flexibility, being able to kind of sometimes, hey, this is not a good situation over here anymore. I've got a better situation over here. Let's move you over here. I think most people, in a lot of ways, when you start getting a portfolio of, well, not necessarily. I know of a lot of, investors who have said, one policy for every property type of scenario, which is fine sometimes, but a lot of times there's a little more flexibility in most areas of the country where you have master policies where you're bundling and sharing that risk between all the properties. But in essence, there usually is an excess and surplus market that an independent agent can usually go to, which is kind of like a last resort. So it's not beholden to the filings within states typically, and obviously look into your specific state's insurance laws in regards to excess surplus or some of these things. But generally, if you can find an independent insurance agent or somebody that specializes in commercial insurance, and by all means, I'm very connected to that. And so obviously David, or if anybody has it, reach out to me. I can always connect you with somebody in local states, because the independent side, we're kind of very connected because we're all in the same boat and need to share our grievances and differences with somebody that understands outside of my wife, because she doesn't want to hear anything more about the insurance market or something like that from me or whatnot, but also to be able to see what's happening in other places of the country. But the independent side usually is a scenario where, if they can't find you something, then you really do have a problem. But sometimes there can be scenarios depending on the state or state in this or different parts of the country where maybe you could exclude the roof type of scenario. So that can be options that could help in some respects. I've heard about that where, you basically, the roof is all on you as far as if it gets damaged. Now, maybe the damage from the roof still has to maybe be in good working condition, but we're talking about more or less heavy loss scenarios from hurricanes or fire stuff. I know obviously in California, there's a wildfire is usually more of a separate category, where you're insured for that or not as well. So it can change drastically between states, but a lot of times an independent insurance agent can usually get to the bottom and telling you which way you need to go or where the best fit would be.
Now, you mentioned the independent side a few times. I know when you're learning a new industry, there's always interesting stuff like this for me to figure out. I always like to get the big picture. So in the mortgage industry, when I was doing that, I was always hearing about direct lenders and wholesale lenders. And what it really came down to was you have lenders that are direct lenders that lend their bank's money. So they work at Wells Fargo, they lend Wells Fargo's money. Mm-hmm. Wells Fargo comes up with programs. That lender gives you a loan that fits with those specific guidelines. Then you have wholesale lenders like us at TheOneBrokerage. And what we do is we work with 100 different banks and we learn all of their programs and we can do loans for all of them. So someone comes to us and we say, hey, that bank isn't going to be your best bet. These guys over here are running a special. They have more money to lend. Your interest rate or your debt to income ratio works better for their program. So let's put you over there. But I didn't know what any of that meant. I just heard people use these phrases and never quite understood it. So can you give me a brief summary of how the overall structure of insurance options works and then how independent fits into that?
Yeah, like I said, you usually have three different areas. One, like I said, being captive, meaning you're kind of like you said, they sell for one brokerage or one company only. Then you have the independent side, which is selling for lots of different carriers that are out there. And, again, regionally or different parts of the country, it can be very different as far as what carriers right there. So that's why we only really stick to kind of like Georgia, Tennessee, and then north up until Pennsylvania, Ohio, and so forth like that, because those regional carriers that we have really strong relationships really only write in those areas. But then the other part is, you've got the excess surplus market, which again are not dictated by necessarily the rate changes that are applied by the city or the state in that sense. But then at the same time, on the independent side, we can get a lot more flexible with how we do things. So in the sense that not every shoe fits the same person. So take Airbnbs. Obviously, where I'm pretty close to Gatlinburg, Tennessee. I'll be there in a couple. That's where the Smoky Mountains are. And I think a lot of guests have become familiar with the Smokies, and it's only.
I got to talk to you then if that's the case, because I may need insurance from you in the future. I've got quite a few cabins out there. So if anybody's listening to this and wants to stay in the Smoky Mountains, then message me and I'll get you in contact with Landry and you can maybe pick some of our stuff. So, okay, go ahead though. You said that that's an example of a regional carrier that insures in that area.
Yeah. But also not every shoe doesn't fit every person in the sense that like whether it's long-term or short-term, not every carrier wants to write short-term rentals. Mm-hmm. Or a big thing around here or some places now is the midterm rentals, which still count as short-term rentals, midterm being obviously more your traveling nurses and so forth. But those are now usually 30 plus days rentals, but typically that still falls under a short-term rental scenario because it's not a 12-month lease, which is what usually from an insurance perspective dictates a long-term rental policy. So when you go to a short-term side of things, obviously not every carrier wants to write that. Or now you've got a short-term rental that's on a lake and they're now renting out paddle boards to the guests to let them use. Well, that's a whole nother risk that now, again, every carrier might be cool with a normal Airbnb scenario, like in the Smokies, but that same carrier might not allow these extracurricular activities that expose a huge liability risk in their eyes. And so therefore you've got to, again, pivot to some other carrier. So independent side can be your best friend in that sense, and finding a good one that really understands property insurance is also good, because most independent sides usually start to niche down in certain areas of what they write, what they know. And a lot of times, like you talked about, where you got to know 100 different mortgage brokers, as far as brokerages, as far as the companies, what they write, what their do's, don'ts, et cetera are. Same thing with us as far as the independent insurance market, and that side of knowing the appetite of which carriers will write this versus which one won't. And a lot of times our questions is not to really kind of find a got you type of scenario. As an advisor, which I consider myself not an insurance agent, but an insurance risk advisor, because I'm trying to nail down what are your needs, where are your exposures at, to try to figure out what's going to be the best possible solution, either in coverages or carriers, depending on where you're at or what you're doing that you're going to need.
Okay. Which areas geographically are being hit the hardest right now?
Definitely coastal. And then a lot of times, like I said, the Texas, Oklahoma, those areas with a lot of hailstorms and tornadoes. Like I said, that seems to be evolving a whole lot more into the Indianas, Ohio's, Kentucky's, Tennessee's, Georgia's. You saw tornadoes even a couple of years ago in Alabama, obviously hitting through Birmingham, I think, in that area. So those are the areas I think that are feeling it the most, just from this perspective that they're not used to, especially more in the Mideast, having seen it as harsh as they've ever seen it as we are now, from both sides of inflation
and when it hits an area like in Alabama or in Oklahoma, that increasing premium is a bigger percentage of both the value of the property and the income of the person that's paying it. So when insurance premiums go up in California, I mean, no one likes it, or in Florida, no one likes it. But if wages are higher, you can absorb it easier, versus somewhere where wages are lower and they're not going up, but your insurance premiums are creeping up more. It's like, it's more devastating. In fact, I've been spending a lot of time in Oklahoma. I've loved the people out there, and I've seen everyone's getting their roof replaced, bro. It's like you just drive down the street and everybody's roof is being fixed. And the billboards are like, get your roof fixed. It's like clever marketing for roofing. Can you give me some insight into what the hell is going on with this like new roof trend?
I mean, here and to that point, it's just roofers will travel. I mean, so if a major storm hits in places,
they're knocking on your door. I was there. A storm hit and they're knocking on your door the next day.
Yeah. They're knocking on the door knocks, and they're saying, hey, this neighbor is getting a new roof. We need to check yours. And a lot of times there's salespeople that have been, I mean, I've loved the roofer guys I know because I trust them. But a lot of times these roofer companies, they're just salespeople who are all using the same crews half the time to put their roofs on to begin with. So they're really just salespeople at the end of the day half the time. But they've been trained for maybe a month and that's it, versus people who are in insurance where they have data for decades on decades and know exactly how long, it would have been since according to the damage there, how long it might have been since that actually happened. So therefore it might not fit in your policy. It may have been maybe it happened with the old policy versus what caused it. I mean, the granular level of detail they can get into is pretty wild and pretty crazy. So finding people you trust that will shoot you straight, I think, is a huge portion of right time, because you do not want to jump to just getting a full replacement on your roof or decline for getting a full replacement on your roof. But to that point, there's been a lot of storms. And so to the same point, like Oklahoma, here in Kentucky, I mean, I feel like 60% of my clients at this point have a new roof in the last 2 years. I mean, at some point, obviously it's got to give, and not everybody's got a new roof, so it should hold up a little bit better on these storms type of deal. But door knocking, that's a huge thing, and it drives me up the wall.
Yeah, and there's an issue with the person who's inspecting your roof is also the person that's deciding if they're going to replace it and getting money. And then it gets even worse when the specific human works for a company and they get paid for how many people they can find to get a roof replaced. So when a roofer shows up and says, we need to inspect your roof, what are the odds they're going to tell you, hey, it actually looks great, I think you're okay? Like, what advice do you have for people that don't know the difference? And a roofing company says, we'll do an inspection, which ironically, coincidentally turns into, we need to replace your roof or make repairs?
I would say start with never signing something, because there shouldn't be a reason why they're making you sign something unless there's some rule out there in the state I don't know about. But that's been a big one around these areas of the Mideast where they will try to say, "Hey, I need you to sign this so I can go on your roof to inspect it." A lot of times, people have not unknowingly signed a contract, so to speak, that they're going to do work with this, or sign a contract saying that we will allow you to file a claim for us, type of deal. So never sign anything without either one, reading it, or first getting a couple other options or opinions out there. Usually, most good quality roofers will do inspections. Now, during high claims area time, obviously where there's been massive storm and everyone's filing a claim at the exact same time, that can be a little bit harder to do because you might have to wait for a little bit of a period of time to start getting things looked at and so forth. And I get that. But again, if you at least get a couple different eyes on it, that's usually a better way to kind of make sure that everyone's story is adding up.
I think we just have a delay, so I thought you were done and I stepped on you, but you were saying don't always. I'll let you jump in with that.
Yeah, so don't always just jump right into filing a claim or signing something first and foremost. A lot of times too, just because there's some storm damage, start to think about the fact that, again, back to the quantity of claims you have, whether that's worth putting it in for something small versus saving kind of like your do not pass go, your monopoly cards for a certain place only when there's maybe bigger stuff that might happen, because you might be screwing yourself over for something that might be a bigger loss down the road, or something that might be smaller that you can eat at this point in time, type of scenario that you think, I can just get a new roof in that sense. So don't always just jump to that thought too. Just because there's a small amount of damage means I absolutely need a new roof or this fixed right now. Your car gets like scratches on it here and there. We all realize our cars are not going to be pristine. And just because there's a scratch here and there doesn't mean we always go out and get a new paint job. If there's real damage that happens that are causing the integrity of my car, that's where I'm going to go get my car replaced or fixed, or see if there was an insurance thing involved to get it fixed. That makes sense by the laws, then sure.
Yeah. Do you think a home inspector is a good person to have look at our roof, or do they need to be a roofing specialist?
It could. I find a lot of home inspectors are pretty generalist in that sense, but at the end of the day, they are there to just kind of report what they see. So it could be a good aspect of having somebody look at things from a different perspective, because obviously they don't have skin in the game trying to get an insurance claim like a lot of roofers do, and could be definitely a second avenue of opinion. So usually they won't do it for free, is the only downside. But if you've got maybe a deal, or you're to work out for several different places, a lot of times spending maybe $400 or $500 to really kind of see, hey, do I have 2 or 3 properties here affected? That can generally save you money in the long runs. Again, filing a claim that's not accepted is the last thing you want to do. And so we always have, and also the other part of it is just, if you when you're on the independent side, normally we say, hey, call us type of scenario. I would say that's one downside with the captives, and there's great captive carriers out there, but you usually don't have, unless it's a State Farm person or a Farm Bureau, you don't always necessarily have an agent or person to really talk to. And so calling the agent and having that conversation, what do you think? Are you seeing stuff? There's usually damage reports they can pull up as far as the weather patterns, and seeing if they really hail hit your area or whatnot as well. They can usually have access to those types of scenarios, but have that conversation up front with your agent first and foremost, I would say as well.
Good. I like it. So talk to your insurance agent as a consultant here, as opposed to just a person collecting money from you. You mentioned a couple things that I talked about in Long Distance Real Estate Investing, the first book that I wrote. You want to get second opinions. So don't just have a roofer look at it, have a couple roofers look at it, or have someone that isn't a roofer look at it. I always would advise people, don't just have your contractor look at it, have your property manager look at it, have your real estate agent look at it, have a couple other people checking on the work. And also use your property management company as a consultant on the area. They're not just there to collect rent from a tenant. Ask them, what are the parts of town you want to avoid? Where are the better parts to invest in? If you have a relationship with an insurance agent that can help save you money finding a better roofing company, or can help save money on the roof, that's better for you. Now that begs a bigger question, which is something I've heard about a lot. And that's people using their insurance to replace their entire roof when maybe a $2,000 repair would have sufficed. They go spend $15,000 to get a whole new roof on. This starts to happen en masse. You start to get crazy premium increases. I first heard about this in Florida. And the way it was described to me is that there's a law in Florida that an insurance company cannot deny you a new roof if there's a storm and some form of professional, I don't know if it's an inspector or an insurance provider, something says there's damage, like any damage at all would either force them to replace your roof or at minimum allow you to request a new roof that they had to agree to. And so what happens is anytime there's a little storm at all, everybody in Florida was just saying, hey, new roof, new roof, new roof. And they were going on in mass. And that led to these crazy high premiums that we're seeing in Florida. I don't know if that is accurate. That's what I heard. So let me know, real talk. Have you heard anything like that? Do you think some of that is going on? And is that contributing to these increased insurance premiums?
Yes and no. I would speak to the fact that, and this back to the roofers part, they like to say this line a lot, especially in these areas where, when there is damage, typically you might get a full roof replacement. However, let's say hail came in and only really at an angle, only hit one slope of your roof and not the other one, because the direction the hail was coming was kind of parallel with that other side or slope of the roof. So that only one side of your roof actually got damaged. Well, a lot of roofers, especially in my area, would like to say, oh, well, one part of the dam is damaged, therefore all of it is damaged, and you get a full replacement. But a lot of them don't realize that is not a black and white scenario with some states or many states. Some states, yes, that's why they tend to say that. Or Florida, I've definitely heard some of those things, but they're trying to work on changing some of that stuff for sure. But a lot of times that you don't want to set yourself up thinking you're going to get a new roof, but there's only damage on one side of your roof. Therefore, insurance in many times is only obligated to pay for said side. And yes, it might not match it might have an old shingle that's no longer made, but as long as when you look at the roof, you can't tell a difference, meaning you can't look at, if there's only two slopes to your roof, front and back, you can't sit there and look at the roof front and back both simultaneously at the same time. You can't be in the front yard and backyard to be able to compare. So there gets to be some gray areas where maybe you filed a claim, but you only end up getting half a roof and you had to pay for the other half to begin with. So again, back to having a conversation with an insurance agent as well, or getting an inspector or some third party aspects to kind of look at it before filing that claim. Because again, just to get an adjuster out there means you filed a claim. So you want to go into filing a claim knowing for sure this is going to get accepted. It is my opinion.
Are you familiar with any laws that prohibit an insurance company from denying it and people are able to get whole roof replacements instead of repairs?
There definitely can be ones in certain states, but again, it's more gray than it is black and white typically for most states.
That may be. And maybe you have regulations that don't make it an absolute law, but they make it very difficult for an insurance company to say no. So now all these roofs have to be replaced. And now what happens is the collected premium has to go up. And so here's why I bring this up. I don't like expenses any more than the next guy does. And I don't like greedy people any more than the next person does. But it's a little too easy to say these greedy insurance companies are ripping us off when the actual culpability may lie on the greedy homeowners that are getting brand new roofs because they can't form a connection between what they think benefits them, which is getting a brand new roof, and what is going to hurt them and everyone else, which is the insurance costs going up on everybody's roof. And if you have that going on, at the same time that you have more storms going on, at the same time that you have higher wages that are required to get these roofs, at the same time that you have the increasing cost of materials going on, at the same time that you have clever marketing happening with roofing companies with billboards and door-to-door college kids knocking and convincing you that you need a new roof, it creates, pardon the pun, the perfect storm of insurance costs, which is kind of what we're seeing.
I totally agree. I mean, and that's why I think point back to the idea of raising deductibles is part of that answer to that, to kind of say, hey, you've got more skin in the game is the thing that carriers are starting to fight back with a little bit and realizing, enough of this aspect of just filing a claim for anything. Definitely in general, I think there's been a culture shift in that, a lot of times, my said parents or other people's parents, their goal is to never put a claim in ever, I'll take care of it type of a scenario, versus there's been a lot more of this, I want to try to see what I can get out of insurance in this sense. And again, insurance is there for a reason and is valid type of scenario. But when the system's abused, like it kind of has been a little bit at the same time with all these things, I mean, it's definitely going to take an impacted effect on everybody across the board. So, I mean, if there's only so much they can do for so long before these drastic changes are having to happen, like we're seeing. And then part of
I
it too
like
can
that
be
solution.
also, go
Oh,
ahead.
sorry. No, you go. Keep going.
I would say another part of it too can be just, again, structuring things along those same lines. Let's talk more macro, bigger scenarios of investing. Is you've got an apartment complex, or I was doing a shopping center um, the other day in, I forget, Tennessee or Ohio or somewhere, where there was it was a $5 million shopping center as far as replacement costs, right? But the way it has allowed us to be so successful as an advisor lately has been that we were able to kind of still win the business. We didn't save the client very much money, maybe sub $1,000 at the end of the day. However, one of the things that insurance companies have started doing is higher percentages, especially in parts of the country that are not used to this, putting a percentage deductible. So forcing your hand at a higher deductible, as well as saying 1% or 2% is your deductible, so you now have more skin in the game. But a lot of times, which not every carrier has dictated that. And so you need to, again, from an advisor standpoint, in my opinion, look at it from both sides. So this client we were able to win, we didn't really save them that much money. However, their deductible for the roof replacement cost on the shopping center was $800,000 or plus $800,000. Their deductible was 1%, but their 1% is of the replacement cost, which was $5 million, making their deductible $50,000 for said roof. If I'm doing my math right there, type of scenario. However, we were able to come in and do a flat deductible of 25,000. So the savings was going to be, if they got hit, they were going to save $25,000 of a deductible at the end of the day. And so there's just a lot of scenarios like that we're able to start looking at and trying to do, and they're forcing our hand to do.
Yeah, and I think that that's actually a wise solution. Is nobody likes a higher deductible, but if you have, I don't know if fraud's the right word, but it's kind of on the spectrum of fraud. Just you didn't need a new roof and you got an entire one because hey, it's going to cost you $1,000 to get a roof. You should expect people to show up and say, I'll take a new roof for $1,000. They're not thinking about the systemic implications of when everyone does this.
No.
And they don't realize that person knocking on their door is a bit of a piranha that's there that some roofing company hired to get a new roof put on the house. They have no idea. They just think, oh, I guess I need a new roof. My neighbor's getting one, right? Like every human makes decisions like that. So if you increase the deductible, you put another hurdle in there that makes it difficult for this to happen. And I just reminded myself of something else. I found out when I was in Oklahoma, many of these roofing companies are not what we would consider a company. So I had it in my mind that they are a company that has a marketing brand like I have at the OneBrokerage, and then a sales brand like I have at the OneBrokerage, and then an operation side like I have at the OneBrokerage. So I thought in my head that these companies were like, all right, we have a bunch of guys that put roofs on. Now we need to come up with a manager to oversee them, and we have to come up with a sales team to sell the roofs and a marketing company to get it in front of people. No, most of them are just marketing companies, and they're all using the exact same roofers to put the roof on. Yep. So if you go with Acme Roofing versus Main Street Roofing, you're getting the exact same people putting your roof on, but you're getting different prices based on how talented the salesperson was at selling you on the price of it. And the marketing channels are just hiring these college kids to go knock on doors or putting an ad up on a billboard or getting different companies to sponsor this. And they're experts at getting the insurance company to pay for it or slipping it through so nobody sees. I didn't realize that there's actually a bit of a racket going on in the roofing industry. Is this something that you've experienced yourself?
Oh, yeah. I would say that's a huge part of it. And like I mentioned it a little bit earlier about that. One of the other things I would say I see as far as I think is a racket to be aware of that roofers do a lot. And again, there's good roofers out there. I don't want to throw the industry as a whole under the bus, but they've definitely taken advantage, or a lot of them have taken advantage. But part of the racket too is that there's so many times where when they go to put a new roof on, make sure they take the old roof off first. I know that sounds crazy, but there's so many of them that there's maybe certain laws in that state saying they can put so many layers of a roof on, but really you get to 2 or 3 layers of a roof. I mean, you're really just devaluing the integrity of your roof if you're not removing the old one and putting the new one on. Because I've seen it so many times where there's been a truss that has been cracked because of the weight of said 3, 4, 5 layers of shingles. And everybody's probably at least been around maybe a pack of shingles at Lowe's or something like that and realize how heavy one pack of those things is pretty astronomical. They're not light by any means. And when you start layering 2, 3, 4, 5 layers or more of shingles on a roof, the weight of that combined scenario can cause problems and integrity to your truss system of your roof. And that is not covered by insurance. So you now might have issues with the integrity of your house because said roofers did not do the due diligence of removing the layers of roof that were on there to begin with before they installed the new one. So just another FYI to all investors or people out there.
That's super helpful, man. And to be honest, I've never heard anyone say that on a podcast before. It's almost always self-promotion and here's why I'm so great. But that's the kind of stuff that everybody wants to hear is like, ooh, what are the little secrets that they're using to get me? So thank you for sharing that. You mentioned the coastal regions. I can add that California is having a big problem, especially Northern California, the Chico area. There's crazy wildfires up there. Some places they're saying we won't give you insurance at all. If you're a California homeowner, and even if you're not, you just like to watch the dumpster fire that California is becoming, which when you travel in the South, you start to realize that's what everybody sees us as. A lot of the insurance that is being provided is actually like state mandated insurance. Like the state themselves is providing insurance for homes, and then they're going to these reinsurance companies that you said to insure themselves, and now they're getting into the insurance game, which is never a good sign. You don't want the government or the state involved in anything if you can help it. It will all turn into the DMV eventually when you let the government do it. But like as a broker out here that sells houses, this has been very concerning as I'm seeing like, hey, this is okay if this is a Band-Aid, but where's the doctor? We need a surgeon coming in to fix this problem. And it doesn't seem like there is one. Have you heard anything out there rumbling in Kentucky of what possible solutions we might have in California?
I have not. I mean, I've heard of the same scenarios, but I mean, I I was going to suggest, like you've talked about, with owning the fact that we're going to have more skin in the game, be much more reasonable, responsible, having bigger savings, like you were able to weather some of those storms, having said savings and not trying to spend every dollar that comes in from it is going to be a necessity type of scenario to help alleviate, be able to get policies or better policies by saying, hey, I'll take a 2,500, I'll take a 5,000, I'll take a $10,000 deductible in the event that there's going to be a major loss type of scenario. And I'll just make sure I'm covered for anything. And under those can go a long way to avoid having to go to said state insurance policies that most states have had to kind of find or do or build from the ground up. And like you said, you don't want any part of that. You want to be able to stick to an advisor, a trusted independent person, or something like that.
Well, I would think at some point the state is going to have to allow them to raise their premiums, and then everyone's just going to be shocked by how high they go. Another thing I learned in this whole thing is that what a lot of the companies have done is sort of create like a subsidy system where if you're in an area with very low storms, not a lot of natural disasters, what should be super cheap insurance, they're charging you more to compensate for the areas that they're writing policies that are more expensive because they can't increase their premiums. So a lot of people are out there that made a good decision that live maybe in a less desirable area, but the benefit was cheaper costs. And now they're having their insurance costs raised to pay for the others. Have you heard about this happening as well?
I've not heard of that specific one, but in general, that fits the rule of insurance as a whole. And so maybe it's becoming more prevalent as far as the percentage that you're having to take in. But in essence, that's the idea of insurance to begin with, which is here's a shared bucket of money, and that shared bucket of money is there for people who have had losses. So not everyone, but if that money has to be filled back up, everyone's going to be experiencing those rate increases. Those usually with claims usually experience a lot more higher percentage increase than those who have not. So typically if you don't have claims, you're still paying less than the average for sure. But I've not heard of that specifically as far as independently within the state kind of scenario.
Well, it kind of shows the principle of how these things work. Like you may be a person that doesn't use a lot of government resources, but when there's an area where people do use a lot of them, you're going to pay more taxes to cover the stuff that you're not using yourself or receiving the benefit of, which causes animosity, which creates bigger problems with socio demographic situations. And now politicians have a harder problem to solve at the same time that they have to make themselves more popular with more people to try and get voted in. And it's just becoming messy as we're starting to see. And I think that the insurance world is a microcosm of how you see a lot of this messiness playing out. All right, so going into the future, what's your predictions of what we can expect to see regarding insurance costs?
Kind of back to what I kind of mentioned, a bit of the bell curve scenario. We expected this year to be the worst, we've definitely seen that. Whether it goes down next year, I expect it to go down a little bit. But we don't, like we mentioned at the beginning, we don't expect rates to go back to 3% or sub. But if we can get back down to a normal percentage, I think we'll be on our way to getting there. So it's going to take a few years for sure before these increases kind of hopefully stop or are very minimal, like we were used to maybe. But it's definitely going to take us several years to get back down to that point. But like I said, things are tending to trend that we are hopefully seeing the worst right now, and that it will start to get better. But definitely expect increases to continue for the next couple of years. Maybe just maybe not as bad as this year.
All right. And then also, if we see inflation start to taper off, which I think Jerome Powell recently said, he thinks that it's slowing down, we may not see premiums rising as much as they've risen. But would you agree we're not likely to see them come back down to what they were before?
I agree. I totally agree about that. And that's why I say set your expectations on that. And with insurance, again, it's a bit more of a trailing effect, like I said, as far as when those changes started happening with the rate increases, it was a lot too late. And so that's why I think the insurance market as a whole, you will see the rates continue to increase for a bit longer than maybe even trailing maybe 12, 24 months, even when rates start to come interest rates and so forth start to come down, inflation maybe starts to calm down. It's still going to be a trailing effect before really we see that really play into the insurance market because they were so far behind.
All right. Last thing I want to cover here. Obviously, if people want to insure a property in your neck of the woods, and we'll get your contact information in a little bit, we want them to call you and talk to you about it. But what if they can't call you? What are some things that people need to know about how the insurance industry works, what type of questions they should be asking an insurance agent, and maybe some hacks or tips that you can offer to get rid of coverage that they don't need, to keep their premium lower, or to get better coverage for the same price?
Honestly, like I said, talking to an independent agent, if you can. As far as general questions, I know it's a cliche answer, but just going on ChatGPT, as easy as crazy that sounds, or as easy of an answer that sounds, I found myself going there a few times because in insurance, every claim usually, for the most part, every claim could be vastly different from the other on what if it's covered, if it's not, this situation, that situation, what every situation is different. So even just going on there and asking about, and laying out the specific inside of things, it's gotten really, really good answers. And I think is a huge tool that people can start leveraging, especially in the real estate investing community, as far as pointing to areas where they up front, they may want to ask an advisor or insurance advisor on, or, hey, I'm not sure if I'm covered in this area, this area, this area. You can even, if people don't know this, you can even upload your PDFs. So you could upload the deck pages of your current policies into ChatGPT and ask it, what coverages I'm in this part of the country. I have this real estate portfolio, yada, yada, yada. What areas of coverage do you see that I'm missing here? So you could try to do some of this research yourself and get a pretty good answer before even talking to an advisor if you can't get a hold of one or don't have one at the meantime. So I don't know how easier it is to get to do that. I mean, you simply just upload a PDF, hit click, send it, and ask it a few questions about it, and it can tell you pretty good.
So what are some of those questions that people should search for?
I think a lot of times I see a massive stipulation as far as where their gap is as far as liability goes, whether they don't have umbrellas, whether they don't have enough liability, whether they've got additional insureds named correctly, they've got stuff in their name versus, moving stuff into commercial policies, whether they are covered for certain, perils, like certain, we call it perils, but certain perils based upon where they are in the country kind of scenario. Because obviously California is vastly different than Kentucky, which is vastly different than Florida. So I would say definitely their liability exposure, because honestly, your liability exposure is where you're going to, if you have a claim there, it's going to be the part that wrecks your entire business. It's not going to be a storm scenario that wrecks your entire portfolio of real estate most of the time. It's probably going to be a lawsuit scenario of some tenant or something like that. And so making sure you've got good liability coverage for said claims, and especially an umbrella for your business. So a lot of times I see people where they have personal umbrellas, which is going to cover you from someone suing you personally, but they don't have a commercial umbrella on top of their commercial portfolio, or they've got a commercial portfolio, don't have something on the personal side. And so making sure from a liability perspective that you're covered. And you can only cover so much. We can't stop, every little critter, ant, et cetera, from getting into a house. There's some, type of scenario. There's always a small gap somewhere. And so it's how much you're willing to risk. There are a lot of times you can mitigate large gaps in the insurance as a whole. And they can do it. It's a good tool to use to be able to kind of identify some of those. And you can just ask it and say, hey, what am I missing here? What do I not know? And just, I think that's been the coolest part about the AI aspect. And I dive a lot into that within our business as far as just retooling my mind of what's capable. And just, if I don't know the answer, a lot of times you can just ask it and say, what can you do this? What is, am I missing here? And they can give you some pretty good answers a lot of times to ask the questions you didn't know what to ask.
One of my favorite questions to ask, and you would think more people would do this because it works like magic 90% of the time, is I will say, what would you do if you were me? I don't know why it works so well, but what happens is when I'm talking to a salesperson, their job is to sell me on why I need a new roof, for example. When I say, what would you do if you were me? If they're any kind of a decent human being, it immediately shifts their emotional state to now, instead of thinking my job is to sell you, my job is to advise you on what I would do if I was in your situation. Some people will come right out and say, you probably don't need a new roof or whatever. But many of them, even if they're not honest with you, you can see the conflict the minute you ask that question. When a mechanic had previously said, I think we should replace your engine, and you say, what would you do if you were me? And there's a big pause. They probably don't believe that they would do what they're telling you to do, right? And even if they then say, well, I still think you need a whatever, maybe they don't think that, right? Maybe what went through their head is, well, your car is only worth $8,000. The new engine's going to be $7,000. You'd be better off to get a new car and not have to deal with it. But when the question was, how do I get my car running? The answer of you need a new engine was the truth. The way we ask these questions can often get to the bottom of the response we're going to get. I think a lot of people are operating under the assumption that the person is giving them the advice that they would do in their shoes, but they're not. So just asking your insurance person, like you just said, what am I missing here? Or what would you do if you were me? They might start asking you more questions. Well, actually, what's your plan for the property? You're going to keep it for 5 years, or are you going to sell it next year? Well, that changes things, right? If that's the case, then I wouldn't do that. I would only do this, or whatever the case would be. And it's a way to elicit out of the person you're talking to better advice rather than just handing over your trust blindly and hoping that they give you the right advice. Anything you want to add to that?
Yeah, I say all the time with questions that we're asking clients is exactly that. What are you doing with the property in the long term? Because there's a lot of times property investors, as we know, we don't necessarily know, are we going to keep this property? Maybe we're going to update it and sell it, or are we going to, hold it type of scenario? And a lot of times that can change drastically from an insurance perspective, and that you really don't want to contaminate what I would, not bad apples and good apples, but you really don't want to contaminate the two in the sense that there's definitely carriers or policies that are better out there for certain situations like we've talked about. If you're flipping the house and doing massive improvements to the house, that needs to be separated from, say, my long-term rentals that are good where they're at type of deal, and a separate policy and so forth like that. So asking those questions correctly, or like you said, what would you do in my position, is a lot easier as an advisor to say, well, let's dig down into this. Let me ask you some questions about this. Don't be afraid to send me your policies, because I need to know what we're working with entirely. And I'm not sitting here controlling the meter of how much the insurance carriers are charging you. That is what it is. We're trying to find the best situation for you for what you have, your portfolio, or what you're doing with your properties.
All right, Landry, anything else you want to add that you wish people knew about the insurance industry or the situation and what investors can do to build their wealth?
We don't make much on every policy, so don't. It's a game of mass numbers, for sure. So it's not like we have a ton of skin in the game and trying to, I want to do what's right for our clients, and every insurance agent is going to make mistakes sometimes here and there, but the honest ones are also going to say, hey, I've screwed up. Let's fix this. Let's get this where it needs to be. Or usually a lot of times just know that we can backdate changes. So like, oh, we should have added this back then. Well, let's fix this and backdate it to when it actually happened type of scenario as well.
So that brings up a question from me to you. If I get a policy and then decide 2 months later I don't need it, or I sell the house, or I want to switch to a different policy, am I locked in, or can I get refunded once I cancel my policy?
Typically, there's some scenarios for these excess and surplus type of policies where maybe there's a minimum earned premium of 25%. That can be a big thing in certain kind of like situations, but majority of the time, if it's on the standard market stuff that's dictated by the Department of Insurance and those carriers and, a State Farm policy or whatever, you're only going to pay for exactly what was used. So if you paid for 12 months, you sell it after 6 months, you're going to get 6 months of premium refunded back to you is typically the rule of thumb.
Awesome. Appreciate that, man. If people want to reach out to you, they want to talk insurance, they want to start a boy band, and they need some insight from you on how they can best go about doing that, what's the best way to get a hold of you?
Yeah, you can reach out to my social media, Landry Fields _. There's only 2 of us. I'm the shorter, much lighter skinned version of the 2 that are out there. You can find me in my local Kentucky specific podcast for investing in real estate and entrepreneurial stuff, or you can reach out to our office at 859-687-2004 anytime, or we've got agents and can help anybody that has questions. And it's a changing market for sure. And I think people are a lot more heightened to what's happening out there. Maybe I should take a look at it because let's be honest, insurance used to be a set it and forget it thing for decades. And I think everyone's realizing I need to take a look at this because I can't, I wanted to mention this earlier. Is like, we can't outpace with rents right now what's happening from our NOI side of things. I mean, a lot of times you're having dictated rents and not being able to raise rents, even sometimes in some cities or some states. And so until rents are able to kind of climb and to where they need to be, you've got to start finding ways to cut costs and in any way you can with your NOI. So here to help.
All right. Very last question. What's something that you think people should know about real estate investing that never gets spoken about on most podcasts or YouTube channels?
No, I'd say honestly, what you've been pointing to for the last couple of years is it's not as glamorous as it looks in the fact that you think you're just going to retire real quick and almost like an influencer, just sit there and be like, look at everything I've done. There's going to be problems. There's going to be bumps in the night. And I'm glad that maybe I didn't purposely do this, but I got in there and actually learned it myself, getting in there and doing probably 50% of the work on my first couple of flips and first couple of rental properties to know here's literally what this entails. Here's how much work this takes, and putting it a little bit in what things should cost and how long this should take as far as the time frame it goes. But also, I'm glad I was able to take chances because I think you have to play offense early on when you don't have anything to lose, and then play defense when you do have things to lose. So learning to adjust and play defense rather quickly, I think, is one of the things that you need to kind of, that no one ever really talks about, that you should be playing defense a lot sooner once you get your foot in the door.
I love that. What do you mean by playing defense?
Just, back to the tax aspect or separating, because it's easy to kind of like leverage, I can buy so many properties in my name. But once you get to a certain number, you really need to start leveraging that and moving things into commercial insurance policies, into commercial notes of different kinds, into tax strategies and so forth. And those things are a lot more complicated. It's easy to kind of get your foot in the door. I've got some properties and I'm going, and just continue that method. And you get so far down the road, you're like, oh, you hope that nothing major happens from an insurance perspective, liability, lawsuit scenario, or a major tenants thing, and that you've got the cash if something happens. But a lot of times you should probably have those conversations with a tax perspective or insurance perspective that most people just don't have until it's too late, or they've gotten way down the road and wish they would have done it a lot sooner.
All right. Thanks, Landry. Appreciate you, man. We'll have you on again soon. Thanks for listening to Real Talk Real Estate. If you would like to be featured on the podcast, I'd love to have you. Visit davidgreene24.com/ask and submit your question there. Also, please do me a huge favor and share the show with someone that you love that you think would benefit from this message, and make sure you're subscribed to get notified for future episodes. If you want to reach out directly, you can also DM me on Instagram or social media, and check out davidgreene24.com.